The next set of ratios we're going to talk about are debt and equity ratios. What's the relationship? In other words, the terms that we're going to talk about is leverage. How much debt does the company have, and can it make payments on the debt? So the top part of this page, the top part of this slide, we have debt ratio and debt equity ratio. Both of these measure how much debt the company has. The TIE ratio down below here and the cash coverage ratio basically are reflections of a company's ability to make payments. And if you notice, the difference between the two ratios is the numerator, where we actually change the numerator from a profit number to a cash flow number. So the cash coverage number is probably a more true picture of the actual amount of cash available throughout the year to make interest payments. So let's take a look. Obviously, larger numbers for debt ratios mean more debt. If we look here we have the debt ratio is the bottom blue line. The industry is a little bit higher. So it shows that in general, for at least these 5 years, Coors has less debt than the industry does. If you look at the debt equity ratio, again, it's substantially different. So what we can say here is that the industry borrows a lot more money than Coors. What I can tell you is, historically, Coors has absolutely no issue with borrowing. Prior to this, in the 2002, 3, and 4 years, they actually had as much debt, if not more debt, than what the industry did. Over the last 2 or 3 years, they have borrowed a substantial amount of money. So now they actually have a very high debt equity ratio and debt ratio. So what did they do when they borrowed all this money? The very next year they started paying it back. So they have a philosophy, if you will. Again, I can't state this for sure. I'm just looking at pictures and telling you what the pictures tell me, is that they don't mind borrowing money. They're not afraid to borrow money when they need to borrow it. But once they've borrowed money, they are strategically geared towards paying that debt off as quickly as possible and getting back to a reasonable amount of debt, at least in their eyes. The TIE ratio, you can see here that Coors has a much greater ability to pay on interest than what the industry does. So they really have no challenges. I mean, they have less debt, so it kind of makes sense that they should have a greater ability to pay. But you can see that it is growing. The industry is kind of growing as well. But we have this increase in ability to pay. The cash coverage ratio, which incorporates obviously a cash flow number rather than a profit number, also again shows that Coors has increasing ability to pay on interest. One of the things that we need to keep in mind, if I kind of come back here, is that these ratios don't include principal. So when you make payments on your car, you can't send them an interest-only payment and say, "I'm sorry, I'll send you some more principal a little bit later." It all has to be paid. So it's not a true picture of ability to pay debt. It's a picture of ability to pay interest. Excuse me. Enterprise value, and in particular this ratio, which was referred to as the enterprise value multiplier, gives us a comparison of the company's firm's value compared to other companies. And the enterprise value is the market value of the stock plus the market value of its debt minus cash. So basically it said, look, what would it cost to buy all the stock and pay off all the debt? That's the enterprise value. The multiplier that we incorporate here is divide that number by EBITDA, which is EBIT, earnings before interest and taxes, plus depreciation and amortization. So how could we ultimately use, or how can we analyze this number? High growth companies should have higher economic enterprise value multipliers. So what do we find with Coors? Over the last couple of years, Coors has declining enterprise value multipliers, which means they're moving away from a growth position and they're moving more to a stable, more of a value position, if you will. Is that good or bad? Kind of depends on what the owners want the company to have. We need to look at, well, how is the stock price being impacted by this number? How do investors feel about the ownership and the management of the company? Lots of questions need to be answered, but it gives us at least a picture that we're moving away from a growth position and more towards a value-oriented position. The next ratios we want to look at are what are referred as value versus cost. We want to look at the market price of the stock. So everybody has heard of the earnings per share. We know how to calculate it. It's net income divided by shares outstanding. But we need to understand, well, what does outstanding shares mean? The outstanding shares are those shares that are in the hands of the current owners of the company. Those are the only shares that can vote. They're the only shares that are incorporated into this number. What is dilution? Dilution refers to how we calculate these outstanding shares. Sounds like I've just contradicted myself, but I really haven't. There are shares that are owned by investors, right? I own 100 shares of P&G stock. Those are outstanding shares. But there are also securities out there that could possibly be shares. So maybe we have employee stock options. Maybe there are options that are available on the company that we've offered to our creditors. Maybe there are a variety of places or securities. Maybe we've issued convertible bonds, convertible preferred stock. These things could possibly be outstanding shares, but in their current form, they're not. So dilution refers to how do we calculate these outstanding shares. Fully diluted shares, which is the number we want to analyze, says, look, what if we were to convert all the possible shares that it makes sense to convert? What if we converted them all to outstanding shares and then use that number to calculate earnings per share? That's the fully diluted earnings per share. So we have two ratios we want to look at. We want to look at market price, or the PE ratio, and we want to look at the book value per share. We're going to spend some time in class talking about this PE ratio because I think it's a very important number. Likewise, we'll talk about the market to book value, but in general, these look at and they relate market prices to something inside the company. The PE ratio reflects how investors feel about the company's future. Market price, obviously, is the price they pay. Earnings per share is the profit they received in the last year. We'll talk about this in class because I think it's an important topic with respect to these market-based ratios. The market to book value ratio, and sometimes you'll see the inverse, this book to market, they both reflect just the relationship between market prices and historical prices. The greater the number, if you will, with market to book, the more value there is in the stock itself, that it's worth more than what the company is. And again, we'll talk about this in class. And one of the things that I screwed up when I was numbering this should actually be a letter, not a number. Likewise with the PE ratio, this should be a letter, not a number. But again, I forgot to change that in this version. So there's no industry data for these, so all we're going to do is show these particular ratios. Here's the market to book value ratio, and you can see that over time there's wide changes. Currently, the Down here, obviously 1.02 is the low value down here. But as you can see, that Coors, at least over these 5 years, has always had a market price greater than the book value of the company. The market price is greater than the accounting value. We'll talk about that in class and why that's so important. Income statement analysis. Now we're going to switch gears and go to the final financial statement here to look at profitability. How profitable is the company? We have the income statement ratios. Gross profit margin measures the control that the company has in the production process of the company, in the creation of sales, in the selling of the assets or the producing of services. What is the profit that's generated from that piece alone? The operating profit margin reflects the greater picture of running the company. It incorporates things like the salaries of the executives, the marketing of the company and the advertising, the research and development of the company. Those other costs are part and parcel of running the company. So the operating profit is this overall control of expenses to manage and run the company. EBT divided by sales, for all intents and purposes, essentially is the bottom line. If you notice down here, net profit margin is what we usually refer to as the bottom line. But as you'll see here, our industry ratios don't have enough profit margin. They have this number. So we're going to be using number 15 here as our bottom line, in quotes, if you will, just to reflect, the bottom line of profitability before we get money to our shareholders. So how do these ratios look? Again, if you notice here, Coors has a little bit of an upward slope. They're better than the industry. So they're not dramatically better, but they are producing more profit from the production and a sale of their beverages than the industry is. What about operating profit margin? And again, it is substantially higher than the industry. So when you incorporate all the expenses of running the company, Coors is a far better managed company as far as controlling expenses than what the rest of the industry is. So now what happens when we go and we now look at the operating profit margin and the bottom line numbers? Again, if you go to the bottom line, you can see that Coors is still a higher, more profitable company than the industry. The net profit margin obviously is this blue thing above here. We don't have to worry about that. But let's just look at the ultimate bottom line. Here's EBT divided by sales. That's Coors. And down below here, this purple line down below here, that is the industry's number for the bottom line, again, without taking into account taxes. So again, what can we say about Coors? Is that they have trouble managing their assets, but on the other hand, they're a pretty profitable company compared to everybody else in their industry. The next set of ratios reflect balance sheet profitability. How much profit is generated relative to some balance sheet numbers. One of the first numbers I want to talk about is something called basic earning power. This isn't in your textbook, but quite frankly, I think it's probably a more usable number than ROA, which is in your textbook, which is return on assets or return on investment. The reason for this is leverage, right? ROA is net income available. This is the bottom line, which incorporates taxes and interest, which is obviously is taxation and leverage and debt. Basic earning power looks at the basic profitability of the company before you look at those other decisions. So I think it's a better measure, if you will, of the overall profitability of the company compared to its asset base. Return on equity, net income divided by net worth. We want to know what kind of earnings is generated for its owners. again, in our the statement that comes from this our industry ratios, they don't have a net income number. It's EBT divided by net worth. So it's not the exact same number, but in general it shows profitability that's available to the owners of the company. And of course, you know what net earnings per share is. So let's look at these numbers. Basic earning power. Here's the industry and here's Coors. The industry has a better profitability based on total assets than Coors does. If you look at the return on assets, you can see that in general, Coors, they're showing that they produce profits, but it's not a high rate of profitability compared to their total assets. Again, this shouldn't be a surprise given what we've learned about Coors and that they have problems with their balance sheet. Profitability isn't the issue. The issue is their asset base and their ability to manage and maintain lower levels relative to the industry. What about return on equity? Sometimes the industry numbers just don't make any sense. I can't explain why the industry numbers look this way, but let's just look at Coors. And again, you can see that in general, Coors is providing profitability to its owners. Again, it looks over the last couple of years, we're up in the ballpark of around the 9 to 10% range. So if you were an investor and you could earn 9 to 10% on investment, I don't think that you necessarily would think that that's a bad investment. So Coors appears to be providing decent profitability to its owners. There is some analysis, there's something referred to as the DuPont analysis. And essentially, it breaks down this number, the return on equity number, it breaks it down into some parts. So we want to ask the question, how can the managers of a company create more return to the owners? Well, there's three things they can do. If they increase the net profit margin, that's net income divided by sales, that should increase ROE, more profitability for them. If they increase asset management, if they're more conservative or more efficient generating sales for their total asset based on their asset base, that's more profitability ultimately can come to the owners. And you can see if you just multiply those things, sales divides out. So now we have net income divided by total assets, which again is our ROA number. And now we multiply that by debt. This is kind of an inverse number here, but it is reflective. It's called the equity multiplier. The bigger the number, the greater the debt. So if we increase this number, we increase return on equity. So how can we get more profit to owners? We can make more profit, we can be more efficient managing our assets, and we can also borrow more money. The more we borrow, the higher DuPont, the DuPont analysis says the return on equity should be. And again, we can see here that the industry has a much higher return on equity than Coors does. Why is that true? Well, here's EBT divided by sales. It's not profitability. Coors is more profitable. What about total assets? We see across the board here, Coors has a lower total asset turnover ratio than the industry. It can't be financial leverage because these numbers are all less. So the thing that's hurting the overall profitability of the company is the company's management of assets. This should be a critical area that they look at to try to understand the weaknesses that the company is currently experiencing. It's a pretty long chapter. There's a lot of stuff there. We're going to go over this in class in some pretty good detail. See you in class.